following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. Join us now for the expert source for inside information on the options markets. It's time for Options Insider Radio with your host, Mark Longo.
Welcome back to Options Insider Radio and the first in our series of live sessions from the OIC 2011 conference down here in beautiful Savannah. They tell me it's beautiful. I haven't had a chance to see much of it yet. I've been sitting in this room for a while, and I imagine I'll be sitting in this room for the bulk of the next 3 to 4 days. So my impressions of Savannah are a nice, very nice, well-appointed boardroom. Our first guest up on the docket is none other than Steve Crutchfield. He is the CEO of NYSE AMEX Options. He is also, as you listeners will remember, was on the show recently because AMEX won our Exchange of the Year award. So Steve, welcome back onto the program.
Thanks, Mark. Great to be back here with you once again.
I love this echo we have in this room. It's very authoritative.
There is a little bit of an echo. It sounds like we're in a room about 10 times larger than it really is.
I feel like I'm speaking to you from on high and giving you my pronouncements. Thou shalt not internalize. All right. Steve, obviously we gave you the award a few months ago in recognition of all the work that's been done to turn around Amex. I know I told you last time I was kind of getting tired of writing the Amex circling the drain kind of story, so it's nice to see that revitalization. And there has been a substantial turnaround in your volume and in your market share since we talked last even. So rather than having me characterize it, why don't you run down for our listeners, give them a brief overview of what's been going on market share and volume-wise at Amex since we last spoke.
Sure. And first of all, thanks for having me on first. I assume that's probably just alphabetical order.
But there you go. You're always first on our list.
Always nice to start things off, and we're looking forward to the conversation. Yeah. So you know we've had, from a market share standpoint, we've had a strong couple of months. We set market share records on Amex both in March and in April. In April, we had 15.1% market share of equity options, which is a high for us since the NYSE acquisition a couple of years ago, and really for many years before that on Amex. So very, very happy with that development, of course. We've had strong growth both in the electronic and the open outcry space. April was a little bit of a quieter month in terms of overall industry average daily volume.
Typically is.
Right. And March, of course, was very newsy with Libya, with other things. But we did continue to have very strong and steady volume on the open outcry side again, as well as electronically. In March, we set an open outcry volume record on Amex, with the exception of the month of May of 2010, of course, which was unique due to the events of May 6th. And in April, we had almost as much volume traded through open outcry, about 650,000 contracts a day on average, which represents between about 25 and 30% of our overall average daily volume. So we continue to have strong outcry volume as well, of course, as the electronic growth that I think has gotten a lot more attention.
And the open outcry stuff, let's just stick with that for a minute. Are you starting to pull complex order volume away from, let's say, Philly and Cboe and other places where those kind of orders are traditionally being put up still?
We have seen a little bit of growth in our complex order volume. We introduced a pricing change on May 1st. We brought customers to a rate of 0 for complex orders, which now means the customers no longer pay transaction fees to the exchange in any of the products that we trade, with the exception of some proprietary index products where we have license fees that are transferred over to the index issuer, of course. But the exchange itself doesn't collect any customer fees now. We also introduced payment for order flow on complex orders, again, making that consistent with the other orders that we execute on the exchange. Both outright now and complex have payment for order flow available to customers as a way for them to monetize that order flow, which has value to the market makers and liquidity providers on the exchange. So since we made those two changes on May 1st, we've seen a little bit of an uptick in our complex order volume. We certainly look forward to seeing that grow as we continue to bring forward a staged release of an electronic complex order auction and facilitation, solicitation, auction mechanism. As you may recall, we've had a complex order book on AMEX for some time. We introduced a complex order auction a couple of months ago, and within the next small number of weeks, we hope, pending regulatory approval, we'll be able to bring our long-awaited facilitation, solicitation order mechanism online as well. And that's very attractive to us. It's really, I think I've described it before, it's sort of a greenfield for us because that's a piece of the business where we've not been able to participate in the past because we didn't have the mechanism available.
Traditionally, AMEX is not your first thought when you're thinking of large, institutionalized, internalized orders kind of thing. That's not exactly a realm where you've been playing very actively.
And we have certainly been able to offer that ability to our large institutional clients primarily through open outcry, but to be able to do so electronically, that's an area where we're looking forward to being able to compete very aggressively with CBOE and ICE and some of the other exchanges that you mentioned.
Now, you also mentioned the growth on the electronic side, and I'd imagine the bulk of that is coming from your intention to. We talked about the share sale last time, and I believe it was still pending at the time. So before we even get into the mechanics of where that volume is coming from, let's give our listeners an update on the status of that. Are we still awaiting approval?
Absolutely, yes. And so great question, of course. That's something that we've been talking about for some time, obviously. Certainly
beginning to hear an echo on that one.
Hope the process would have been quicker than it was. But yes, you're absolutely right. We are still pending approval. We did finally formally publish our filing to effect that transaction on March 17th, I believe. There was a public comment period. That public comment period has now ended. And the SEC, we hope within a short period of time, will be acting to make a final decision on that filing.
And just to review for our listeners, I imagine the bulk of them have not had a chance to review that filing, but you are proposing to sell approximately 53% of the exchange to various order flow providers and liquidity providers, including Citadel and Barclays and Citi and a handful of others, I believe, in there. Which names am I missing?
Goldman, UBS, Merrill, and TD Ameritrade.
Goldman,
that's right.
Citi, Goldman and Citadel, the two majority 15% holders.
That's right. 14.9% for each of those, and then smaller stakes for the other five partners as well. 52.8% of the exchange we're selling, although NYSE will maintain through a board structure a controlling stake. And it's also important to note we're not selling a stake in the self-regulatory organization. And there was a comment letter filed by one a competitor, which was actually filed after the deadline, interestingly enough, to file a comment letter, which although it didn't oppose the transaction, it contained a little bit of misinformation, and it mentioned that there could be they might have concerns theoretically, although again no specific concerns were raised with an exchange selling a stake in a self-regulatory organization. NYSE Euronext is not selling a stake in the SRO. It's selling a stake in a facility that operates the NYSE AMEX options business. NYSE Euronext retains all regulatory control.
That's a surprising thing to hear that a competitor would use a comment letter to spread disinformation.
Yes, who would do such a thing,
Steve?
Shocking.
Yes. This is news to me. But I imagine you mentioned the growth of your electronic order flow. I'd imagine the bulk of that is due to that arrangement you've set up and how your new partners are starting to send more orders your way, even though the deal has yet to be approved.
Certainly we've seen some growth there, although we've done a number of other things as well. Of course, I mentioned some pricing changes. We have more in the pipe. We replaced all of the legacy AMEX technology some time ago, and then again replaced all of it last summer with the new universal trading platform, which is the NYSE Euronext global standard execution platform now. And then actually last month we completed the migration to the new Mahwah data center, which involved again replacing all of our hardware and servers with higher performance infrastructure. And what we've seen since then on an aggregate basis on average and all the way out to the 99th percentile actually is much better turnaround times in terms of performance for market maker quotes. As with all technology migrations, there have been occasional issues that we're working to address naturally. But in general, we're very pleased and I think have a great feeling about what that's going to do for the latencies that our customers see going forward.
Now, Steve, obviously I can't bring you on without at least mentioning the 800-pound gorilla in the room, which is, of course, the many pending deals swirling around AMEX and NYSE. And I know you're limited and constrained in what you can say on this topic because it is an ongoing deal. But, maybe we can talk about it more in a just 10,000-foot theoretical sense. We've heard a lot in the media about derivatives, the drivers for this deal on both sides, the NASDAQ bid, ICE bid, as well as the NYSE bid. Derivatives is driving it. And yet when you start to parse it from an overview, looking at it, how it impacts options, which obviously is our purview here and what most of our listeners are interested in, it becomes a little bit more interesting, I think. And so maybe just without even any sort of commentary, just in general, would you say looking at some of these deals and what you've seen, obviously the hype about derivatives notwithstanding, Do you think options were a major driving force in this deal?
First of all, I can't blame you for asking the question. I will say that I'm highly unable to comment on the merger, of course, or any potential merger that may or may not occur.
We're just talking as friends. It's just me and you, Steve.
Just me and you and a couple of microphones. Yes. There's not much I can say, and I don't want to comment on what may have been the driving force to motivate some of the deals that you see out there right now. Certainly, we're talking about a couple of entities, each of which have stakes in a number of different businesses, including the derivatives business. But for the time being, and until any ultimate deal is consummated, my job is simple, and the job of all of us at NYSE is simple. We are competing as aggressively as we can to run the businesses that we're running today, and to make them as strong as possible, and that will be include taking actions that may be to the detriment of every other exchange in the space, including those that we may one day end up partnering with in the future. So, very much business as usual for us until further notice.
I have a feeling that's going to be the theme of the show this year. Every single person who's coming on is involved in an M&A deal in some way, shape, or form. On the exchange side, on the brokerage side, we're going to have a lot of no comments. So I'll have to do a lot of dancing this week and see if I can get
don't blame me for trying.
People to say anything. I imagine our listeners would revolt if I didn't at least mention it. Of course, speaking of exchanges and acquisitions and the exchange space in general, the exchange space has evolved yet again, or it is in the process of evolving. Of course, over the past few weeks, we saw yet another new name throw their hat into the ring. The Miami International Holding guys, a lot of former Philly NASDAQ guys, are putting together a new exchange with some tentative launch dates. Obviously, very early. All we know is some preliminary information on what they've been up to so far, but just based on what we've seen so far, not just the generic, is there room for another competitor in the space, but what's your take on what you've seen so far in terms of where they're coming on the space? From what we've seen so far, I'll give you my take. Maybe I'll start you off then. It appears to be similar to what we've seen with NASDAQ OMX, which is they're focusing on tech, they're focusing on price, and going to be another one of those fighting in that maker-taker space. Is that pretty much the impression you're getting as well?
I've heard very few specifics, and I'd love to offer up an opinion, but I think, frankly, don't have enough information. I know some of those guys very well. They're putting a great team together, and I'm sure that they'll eventually be a strong contender. I think they've tossed out a date of Q2 2012. In the exchange space, I will say it's typically when you hear a date that far in the future, it's probably and going to end up being even farther in the future. Definitely fluid. That of course applies to us as well. A lot of these are very big technology infrastructure projects that take a lot of time and are tricky to get right. Some of the comments that they've made along the lines of sort of implicitly criticizing existing exchanges for using legacy infrastructure, we find to be a little bit strange, given that as I mentioned, we replaced all of our infrastructure last summer. I think that comment was the first time I'd heard somebody describe our industry standard, and we believe really the best technology platform in the options industry, the universal trading platform, described as quote unquote legacy. So we'll see what they come up with, and certainly we'll look forward to hearing more about what they've got planned as that date gets closer.
I agree. That's one of the things that makes us interested in otherwise just be another new exchange. But we do know several of the people who are involved in that, and they are people who've been around the space for a long time and certainly are serious about options. So we'd hope that whatever they bring to the table would be interesting. And what I've seen so far, like I said, it is very preliminary, but what we've seen and just from our own digging, you mentioned the legacy technology. That seems to be a big focus of what they're pushing. It is tech. And we heard this before, similar argument with BATS, with technology and pricing, and NASDAQ OMX when they came into the space with technology and pricing. And I was a little disconcerted to not hear this new exchange or some of the other recent ones not mentioning new sources of customer growth, where we're going to actually build the business, as opposed to yet another exchange coming in to carve off a piece of the top 1,000 series, the front month at the money liquidity, where frankly no liquidity is necessary,
right.
And essentially coming in and offering a new pricing scheme and new technology. As interesting as that may be, the actual growth for the business, I feel like I'm channeling Gary Katz now, grow the pie, but as something like that, where we're not hearing much in the way of that mantra yet from this new exchange.
I certainly agree, and I'll take it even one step further than that. We certainly at NYSE and at AMEX Options agree very strongly that providing additional strong sources of liquidity is extremely important. And what I see that concerns me about the industry is really the industry going almost much more in the other direction. I mean, you mentioned the leader of the ISE, who's someone that I have a lot of respect for, but I think they've made a mistake in introducing the qualified contingent cross order type. Now, that's something that we've all gone on the record for, and it's yesterday's news, and we don't want to fight old battles. bats. And indeed now, from a competitive standpoint, as we've discussed, I think, in the past, we're finding that we need to go forward and offer something similar, and in fact have filed to do so, and we'll make that available at a time of our choosing.
All their heated rhetoric over
SIBO now and NASDAQ. I mean, so this is what happens, right? Somebody introduces something that is detrimental to market structure, but it puts them at a competitive advantage and everyone else. So it results in this growth of these mechanisms that are, we believe, again, detrimental to liquidity and provide disincentives for market makers. Another issue that we're very, very concerned about right now is the directed order mechanism that BATS has filed. We filed a comment letter on that just recently in which we laid out in great detail what our concerns about that are. But briefly, what they've done is they've created a mechanism where a selected market maker can have an order directed to them, and only that party is eligible to trade that order at a hidden price in between the bid and the offer. And the biggest concern with this is it can result in inferior executions for customers, because if multiple market makers have those dark orders better than the bid, and the customer happens to direct that order to the one with the inferior price, that will trade. So it'll trade right through another price made available by another market maker, which is really, I mean, you're laughing, it's remarkable.
That sounds like 1999 and 2000 all over again, where we were at trade throughs left and right.
It provides a disincentive for market makers to quote aggressively, because why would you, when you can trade with this special select order type and get 100% of the order from the customer you want to trade with, and meanwhile anyone else who's out there displaying their order is subject to adverse selection, because unlike a market maker who's using one of these dark orders, anyone else doesn't have the ability to decide who they trade with. They're eligible to trade with anybody, and theoretically, of course, to be picked off, the typical adverse selection risk that market makers do and should have as part of their business. So we're very concerned about that, and it's also important to note that their proposal is nothing like, we have something we call directed orders on AMEX, for example.
Directed orders have been around for a while.
It's very standard, but the industry standard directed order practice involves displaying, the market makers display their price, and there's price competition. You don't get to trade with a directed order if you're not at the best price. So it's very, very different than what BATS has proposed. We have a lot of concerns about their proposal. We've gone on the record with that, and we certainly would urge the SEC not to approve that proposal.
I'm glad you brought that up. I know you have to run in a few minutes, so we'll cut it short pretty quickly. I'm glad you brought that up, because actually that was something I did want to get to, which is, we're seeing now that so many of the exchanges have merged towards for-profit companies, and they're seeing analysts tracking them and investors, and the focus is on growth. You think we've started to shift towards a volume at any cost type of metric, where exchanges are looking for new sources of growth and new sources of volume, regardless of what the long-term impact of that volume may be, and if it is in fact detrimental or disenfranchising to an existing core pillar of the options market that exists right now?
I think there certainly is some of that, but I think it's short-sighted even from an exchange standpoint. I mean, the reason that we haven't adopted that approach, first of all, you can always buy market share, right? And we've seen some of that with some of these dividend strategies that others have criticized very roundly. I think we've taken less of a strong view on that. It's sort of irrelevant if somebody else wants to allow these very large trades to go up in a way that doesn't generate revenue for the exchange. That's their decision. It's league table volume, we call it. But again, I think taking the industry in a direction that is detrimental to liquidity, to market makers, in the long term is not in anyone's interest, including that of the exchanges, because what we don't want to do is go down the path of disenfranchising market makers to the point where they widen out their quotes, they pull out of the market. We've seen some of this already. It's much more difficult the small and mid-sized market maker shops that for many years were predominantly based out of Chicago are pretty much either acquired or gone, with some exceptions, and we certainly wish all those guys the best. But it's a trend in the industry that is of some concern, and market makers are very, very important in options. It's not like the equities market where you've got an underlying that exists and there's a bid and offer, and somebody's always going to want to buy and sell it, and that's kind of it. We've got many strikes, many terms. You need to have dedicated liquidity providers, and something we were talking about actually this morning in another meeting. We've got a proliferation, in fact, of more and more strikes. We've got 50-cent strikes, dollar strikes, and so forth. You'd need to have market makers out there providing liquidity to maintain a fair and orderly market, and for that to work, you've got to have a market structure that creates incentives for those market makers to display their best possible markets by the light of day, and that's the structure that we're advocating for, and we'll continue to advocate for at NYSE.
Well, I'm glad to hear you say that, and it's not just me beating my drum by myself. But Steve, like I said, we could go on about this for quite a while, but I know you have to run, and we have to bring on our next guest. But before you go, I'll give you a chance to plug any announcements you have coming up here at OIC, or anything you think our listeners should be made aware of?
Yeah, well, I would just say, as I mentioned already, we've made some pricing changes in our complex order book to make trading complex orders on AMEX more attractive for customers who will now trade for free. We're looking forward to expanding that with an electronic offering in the very near future, again, subject to regulatory approval. And we've got some other things up our sleeves in the new product space and elsewhere that we look forward to talking about when we're able to do so, but I can't say much more about that right now.
Great. Hopefully maybe one of them will be binary options. The long discussed between you and I binary options. Maybe we'll see a return to those one of these days. But Steve, I'm glad we can bring you on the show again. We'll have to bring you on again when we have a little more time. I know we're a little pressed for time now, but I'm glad we could at least squeeze you in and start off our OIC 2011 coverage with you. So thanks again for coming on, and we'll have to have you on again down the road.
It was great to be here, and I still am waiting for my diamond-encrusted plaque, by the way.
Did I say diamond? I think I might have meant diamond each. How about a nice T-shirt? No, the plaque is on its way. It's being engraved as we speak.
I'll take a T-shirt.
It's hard to carve diamonds. It takes a little time, so it takes a little bit. Okay, thanks for coming on, Steve.
Thanks again, Mark.
And that's going to do it for this episode of Options Insider Radio. Be sure to visit www.theoptionsinsider.com for more episodes of this program, as well as breaking news from the options market, the latest articles and analysis from options experts, a wide variety of options education, and of course our discussion center where you can share your questions, comments, and insights with your fellow Options Insider users. While you're there, be sure to register for our monthly email newsletter, as well as our free email alert system. Our email alert system makes it even easier to stay up to date on the latest content from theoptionsinsider.com. Thanks again for listening. My name is Mark Longo, and I'll see you next time on Options Insider Radio.
Options Insider Radio was created by Mark Longo and produced by Gene Crotty. Options Insider Radio is a production of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.